This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 26th. Some highlights from today's show. The calm before the storm. Trump readies his Fed pick. And let's discuss some S&P 500 breakout. Good day, traders, and welcome to the Daily Market Rundown. It is, again, another very, very quiet European session. It has been the theme pretty much since we had the Middle East de-escalation. Now, it's important to understand that this theme is going to stick around for some period still. And it's important if you're a new trader, this can be quite frustrating. It can be quite annoying, particularly if you are going through a little bit of a drawdown or perhaps you're not really making much P&L. The key thing to understand, of course, and this is a little bit of a words of wisdom, you don't want to be chasing in these markets. These are not the kind of markets that are going to pay out easily. If anything, these are the kind of markets that we want to kind of term death by 1,000 cuts. You could be sitting there pretty much every day headbanging your desk, just taking these little cuts, and they're not necessary. Okay, now it's important to understand why these markets are happening, but also when they're likely to end, and that's what we're going to talk about as we get into theme number one today. So heading over, of course, let's talk a little bit about ultimately this idea of investors shoring up defenses against another market August rout. Now, cast your minds back to last year, August. What happened? Well, we had a mini recession. It was very much a case of the economic data had been slowing down April, May, June. And then, of course, in July, we started to see quite a bit of a drop-off in the hard data. In August, we had the really, really bad non-farm payroll print. Okay, the market went on a tizzy. We had a very aggressive sell-off in the equity markets. As of course recession pricing was raised quite high. We of course never had a recession, everything rebounded. The Fed did, however, cut 50 basis points in September. Okay, so a little bit of context, that's what happened last year. Now, to a very big degree, the reason we had such a big sell-off last year was because typically no one's really trading around July, August. Why? Well, because it's summer in the Northern Hemisphere, which typically means that liquidity is at a premium. Okay. Also, don't forget, going into sort of August last year, the markets had been bidding up. We of course had a very low vol environment, so a lot of the typical CTAs that are forced to buy in a low vol environment, ultimately they were forced to sell in a very high vol environment. And so we just had a scenario where we had low liquidity, or at least liquidity at a premium, and we of course had forced selling. Okay, that was what created last year's August sell-off. Now, we do almost have a potential repeat of last year in a sense that we have had the hard data slowing down for the last 2-3 months. We of course also know that going into this summer, we are going to be dealing with the repercussions of the CPI prints. Okay, don't forget, everyone knows that the next CPI print and the one thereafter are the two key ones that are going to tell us exactly what the pass-through effect of the tariff situation is to the consumer. Okay, so people are going to be nervous going into these next two prints, and so we could have very, very fast-paced markets in July and August. Okay, and that's what this article is going on about. It's talking about this idea that there is some hedging now, and we'll talk about that chart in a minute, but there is some hedging going into this scenario. And that's the key thing to take away. Now, the only thing I want to say is that when you read an article like this, they frame it from a couple of sources as if everyone is hedging. The reality is no, not everyone's hedging. Some people will be taking out some portfolio protection, but more importantly, they'll probably be taking out that protection closer to the event. Why? Well, because think how damn expensive it would be to buy 2-3 month protection now. Okay, now obviously there is that sort of old market saying if you buy protection when it's cheap, but people don't typically buy it when it's cheap. Right now it is cheap. We can see the VIX trading just south of 17. So VIX, or buying protection now is relatively cheap. Don't forget we were trading levels of 30, 40, 50 just 2-3 months ago. Okay, the point is no one's buying protection yet. But as we move into the events in July and August, we are going to see the vol pick back up. Now, what that means is for you as a trader, we're probably going to stay pretty dead until after the 4th of July. Why 4th of July specifically? Well, let's go through a few things and let's discuss but what the economic calendar looks like in terms of the next 2 weeks. So obviously this week we do have the month end to contend with. We've got the month end rebell that will start probably tomorrow. You'll start to see the bonds flatten out a little bit. And then, of course, the actual month end goes through on Monday. Okay, so the market is fixated on that. They're concerned by that. And we'll let the portfolio managers get that done. Okay, we then move into Tuesday next week, where the focus is perhaps going to be on the floor or the Senate getting the bill over to the floor. And the big beautiful bill, that's kind of going to be where everyone's fixated and focused. But there's no real, I don't want to say there's no risk, but there's a very limited amount of risk for markets to navigate as we move into next week. Now, sure, there will be some ISM data next week, and that's why we can see as we move into next week, we can see a little bit of an uptick in the implied vol. Okay, so we can see that there's perhaps the ADP. It's a secondary piece of data point, no real correlation to NFP. We could see, of course, with the manufacturing data, well, we did see some really good prints from the market PMI. So again, sure, there'll be some hedging, but they are secondary data points to what, you know, the non-farms and the CPIs. Okay, so in other words, there's not much in the way of eco data next week that can upset things. Now, what can upset things next week? Well, we do need to find out about the tariffs. That's one thing that as traders, we need to be very highly alert to. We are going to find out at some point about what the next step is for tariffs. That is a massive risk for markets. But how do you price that? Okay, if I'm a portfolio manager, how do I price that? Okay, do I go with the taco trade where, look, Trump might come out with words and he might come out and say, oh, you better agree to it, otherwise blah, blah, blah. Or do you price it out 6, 12, 18 months and say, well, look, the end point for tariffs is always going to be better than worse. Okay, and that's kind of how the markets look at this. They look at the tariffs as not that it's not a risk, but it's a risk that can be looked through. Okay, and that's why we are pretty much trading at record highs in the Nasdaq at this point in time. Okay, but the tariffs, yes, they are headline risk, and perhaps we get something about that next week. But don't forget, we've got 4th of July on Friday, which means the markets kind of just want to get to Thursday. And if nothing's happened by Thursday, you can bet your bottom dollar nothing's going to happen, and we are going to go into the long weekend. Okay. Now, the first real risk event, the first major risk event, comes effectively on the, let me double check, I think it's the 10th of July, the 11th of July. Okay, that's the first date at which all of a sudden, we need to start paying attention, simply because that is ultimately when we get the non-farm, somewhere around there. Okay, now we know the 9th of July, obviously that is tariff deadline day, so the markets will be contending with that risk. But like I said, we need to wait for the headlines before the market can actually start to price what that risk might look like. Okay, so from after the 4th of July, this is the point, from after the 4th of July, you can start to expect the market vol to pick up. Okay. Until then, expect low volume, tight ranges, no trend, sideways market, don't play breakouts, don't go with the flow. That's what you kind of have to contend with until after the 4th of July. Okay? Today's the 26th of June, which means between now and the 4th of July, we've got 8 days. Okay, we've got 8 days to contend with. Perhaps things only pick up in around 10 to 11 days. And that's ultimately the key message today is don't sit there banging your head against the desk. Don't sit there giving away ticks. Just get through the next 2 weeks and then we will start to see things pack back up. Okay, that's the key message, of course, from the implied vol chart. Now, in terms of Trump, he came out again yesterday, a little bit of chitter-chatter, again bashing President or the Fed Chairman Powell. Again, I think the key takeaway from yesterday that is perhaps important but not important. Trump has told us, he's nearing the time when he can announce his pick. Now, that shouldn't be news. We know that whoever he picks is going to be dovish. We know that whoever he picks is going to be coerced into some degree to cutting rates relatively quickly. But again, until then, this idea of a shadow chair, it's actually just ridiculous. This idea that a shadow chair can force the Powell to cut rates in advance, it's all ridiculous. Okay, the reality is that May is when Powell's term ends, and between now and May is a long, long time. Okay, and very clearly Powell is not going to be politically influenced. He's not going to step down, even though there's this idea of a shadow chair. Okay, so the key takeaway from all of this is that whoever Trump picks, it's going to be dovish. But don't forget, Powell's very clearly told us, should inflation not come out hotter than expected, should the labor market suddenly slow down, they're going to be cutting. Okay, so don't read too much into this. What you do want to know is, who are those candidates? Well, we know Kevin Walsh. He's quite well respected by the markets, of course. Scott Bessent is very well regarded by the markets. They'll love both of those picks. And then, of course, Christopher Waller. He's been at the Fed for some time now. He's the current Fed governor, so it's not like he's new to the markets. None of these picks ultimately, other than perhaps Kevin Hassett, none of them will be a concern to the market. The one that may be a little bit interesting is Kevin Hassett. So again, these are his nominees, but of all of them, Kevin Walsh, Christopher Waller, and Bessent, they'll all be very well received by the markets. Okay, there's nothing ready to see except for perhaps if you're bored and you can just read it and it's interesting. Okay, now in terms of going into today's session, we've got to do something. We've always got to be prepared for potential opportunity. I think the key takeaway from yesterday, which is quite interesting, is on the right side we've got the Russell. Okay, so that's the Russell RTY is the code in the futures. On the left hand side we've got the NQ. Now the key takeaway is, of course, we know Nvidia hit a record high again yesterday, and that also means Nasdaq hit a record high yesterday, and it's very much the tech stocks that have been leading the rally to the upside. We can see a really nice rally since the Sunday sort of open, but notice the divergence between between the candles. Okay, so yesterday that is the Nasdaq and that is the Russell. Okay, very, very opposite candles, and again, this might be nothing, it might be something, but it does point to this continued idea that the Russell is very much been the lagger all year. Why? Well, because you're currently sitting with interest rates at 4.3%. Okay, the reality is, until the Fed starts cutting, we're always going to see the Russell underperform. Should that change? Okay, again, it also depends why they're cutting. If they're cutting because we're staving off a recession, well then a Russell is still going to be the underperformer. But if they're cutting because perhaps inflation is not as problematic as expected, well, and guess what? You're going to see a switch here. You're going to see markets move out of the tech index into the Russell, and you'll start to see Russell outperform. Okay, keep that one in the back locker, because at some point, if the Fed does start to cut because inflation is perhaps not as bad as expected, okay, Russell is where you want to take aim. Okay, that's where you are going to get maximum risk reward, and like I said, you'll get some form of a move out of tech, profit taking out of tech into the Russell, and the Russell and the small cap should start to outperform. Okay, now in terms of today, where do we go? Well, I think some technical analysis on the S&P 500. What you can see on the right hand side here is effectively a composite profile. Okay, it is this week's composite profile, and you can see very much we started down here in the Sunday open. We rallied pretty much the whole of Monday, Tuesday. We accepted a bit of value Monday, Tuesday. We then had a breakout gap. Okay, and that's this low volume area. You could see markets just spent no time once they broke above that 60-70 level. That was the breakout gap. You can see, of course, that LVA, or that low volume area, runs all the way up to 61, 110 basically. Now that low volume area is what we call a breakout gap, or a breakout low volume area. So long as that holds, the trend is intact, the trend is strong, buyers are strong, and you do not want to be a seller. That's the point of it. What we should see now is higher lows. We've got one there, we've got one there. Don't be surprised to see another higher low today. So it should step its way up the page. Okay, now where that higher low comes in, I don't know. But what I do know is that you got to pick those spots where effectively a higher low could form. Where could it come in today? Well, I think somewhere around that 61.38 all the way up to 45s. I think somewhere there, 38s to 45s, you'll be allowed to buy the market, and you should, in essence, be allowed to make some ticks. Okay, that's kind of how you're playing today. You can see we're making higher lows, and at the same time, we're making this series of higher highs. Okay. Some of you will call that a funnel, whatever you want to call it. Draw your lines, however you want to do it. The point is, we are funneling higher, and of course, so long as we don't get any catalysts to suggest otherwise, we're probably going to continue in that pattern until the end of the week. Okay, now let's turn to oil, because I think oil is also somewhere where we can have a little bit of work to do. We've been talking about this all week. Again, with that composite profile, we can see since the tensions have eased, we're just forming a big fat distribution zone here between 64 and 66. There is a lot of reluctance here. I think that's the key takeaway. If you watched yesterday's session, it really didn't want to go anywhere. It eventually did go somewhere, and then ultimately settled back down. Okay, the key point is that it doesn't seem to be wanting to go anywhere fast. And what that means is we're probably going to stay in this price range between 64 and 66 until further notice. Okay, so what that means is, like I said yesterday, and I'm going to repeat it, and I'm going to sound like a stuck record: buy 64, sell 66. That is the play. It might start to look aggressive to the downside. That's what you want to buy into, because there's absolutely no reason for us to go lower. It might start to look aggressive to the upside, and it has absolutely no reason to do so, and that's why you want to sell into it. Okay, it's very much going to just stay inside this range, perhaps extend a little bit to the upside up towards that $68 a barrel at some point. Maybe even it extends on the weekly low, but it's really going to struggle down below there without any kind of catalyst. Okay, that is then a wrap for today. As you can see, it's quite a short rundown, and for good reason. There is not a great deal going on, and so what that means is we just have to kind of pick our fights. Okay, that's my key message for today. Pick your fights for the next 10, 11 days. Don't be sitting there all day trying to, make your month, make your year. It's just not the time. Get yourself over to the 4th of July, have that break, come back after the 4th of July, and by all means, you have to be expecting fireworks beyond that point, because like I said, we've got the non-farms to contend with, the CPI to contend with, the tariff situation to contend with. There's going to be a lot to contend with in the month of July, but we're not there yet. Okay, if there are any other questions, do post them in the Discord channel. Otherwise, as always, good luck out there. Manage that risk. Go make some money.